Accounting concepts. Accounting concepts. Accounting concepts. Accounting is the language of business. Accounting is the language of business. And concepts, what do you mean by concepts? This is the language of business. It is a language, it's a skill, it's an art. You can develop a skill. So accounting skill can be developed if you know the language. So it is a language, a skill which can be developed through practice. Then what do you mean by concepts? Concepts means assumptions. Assumptions. Concepts are conventions. They are principles, rules, doctrines. But accounting rules are different from rules of science. Think about law of gravity. What is law of gravity? Earth attracts every object towards its center. Whether you believe or not, Earth attracts. Law of gravity exists. It does not depend upon whether you are following it or not. But accounting rules are different. They are assumptions. They are developed for the purpose of developing this language. To learn a skill, you have to depend upon certain assumptions. To develop an accounting system, you need certain rules. For example, when you drive left side of the road. That is a rule for driving. But this rule is not applicable in all countries. Some countries the rule is different. You have to drive on the right side of the road. That is the rule. That is the rule in that country. In India, the rule is left. In other countries, in some other countries, the rule is right. So, accounting rules are like that. They are applicable. Some rules are applicable in some countries, not in other countries. Some rules are applicable in all countries. Universal application. Accounting concepts, there are several accounting concepts based on which the language of accounting has been framed out. But the basic accounting concept is business entity concept. Because it is applicable universally, everywhere. Without this concept, you cannot speak the language of accounting. So business entity concept is an assumption. Even though it has application universally, it is an assumption. What is an assumption? Imagine this is an aeroplane. Assume that this is an aeroplane taking off. Assume that this is a car. Assume that this is a boat. Assume. So you can assume this marker as an aeroplane, as a car, as a boat. But I cannot tell you, I cannot demand from you, assume this is a marker. Why? This is a marker. assume something which that item is not. Actually it is different, but we assume it like that. In accounting, we assume that business entity and owner or owners are different persons. So we are doing the accounting work, the recording work. We make this assumption that business entity is one person, owner is another person. How does it work? Mr. B is a businessman. He started a business. The name of the business is B Positive Enterprises. B Positive Enterprises is an organization, a business organization, business entity started by this gentleman called Mr. B. B is the owner. B Positive Enterprises is the business entity. In accounting, they are not one and the same, they are different persons. They are different persons. The sole proprietor of B Positive Enterprises, Mr. B, is different from B Positive Enterprises. So whenever B contributes money to B Positive Enterprises, the accountant of B Positive Enterprises takes it as a transaction and record. Whenever Mr. B withdraws money from B Positive Enterprises, the accountant of B Positive Enterprises records it in the books of account of B Positive Enterprises. It's a transaction between B and B Positive Enterprises. Whenever B pays money to his daughter, the accountant of B Positive Enterprises does not make any recording because it's not a transaction of B Positive Enterprises. So whether a transaction is to be included in the books of accounts of B Positive Enterprises or not is decided by one factor. Which is that factor? Whether B Positive Enterprises is a party to that transaction. A transaction is between two persons. If one person is B Positive Enterprises, then it is a transaction of B Positive Enterprises. Otherwise, it is not recorded by the accountant of B Positive Enterprises in the books of accountant of B Positive Enterprises, even though it's a transaction for Mr. B. Now, B married a beautiful lady called C, and C is B's wife. B and C together decided to continue this business. They have changed the name of the organization. The organization is B and C Enterprises. B and C Enterprises. This is a partnership firm where there are only two partners. One partner is B, second partner is C. They are life partners, they are business partners. Their organization is B and C Enterprises. Whenever there is a transaction between B and C Enterprises, the accountant records. Accountant means accountant of B and C Enterprises. Recording is done where? In the books of accounts of B and C Enterprises. Whenever there is a transaction between C and B and C Enterprises, it is recorded. Whenever there is a transaction between B and C, it is not recorded in the books of accounts of B and C enterprises. Because, what is the reason? Because B and C enterprises is not a party to the transaction. Not a party to the transaction. So, when can an accountant of B and C enterprises record transactions? When B and C enterprises is a party to the transaction. So, B and C enterprises, the recording function is done to know the assets and liabilities of B and C enterprises, the expenses and revenue of B and C enterprises, the profit or loss of B and C enterprises. The assets and liabilities of B is different from the assets and liabilities of B and C enterprises. The assets and liabilities of C is different from the assets and liabilities of B and C enterprises. Legally, partnership firm and the partners are same. The partners have unlimited liability, but in the accounting language, they are taken as different. They are taken as different. Profit of B positive enterprises is different from profit of B. In a particular year, the profit of B can be different from profit of B positive enterprises. Why? B can have several other business organizations. B can have other business sources of income. So the profit of B in a particular year is different from profit from B and B positive enterprises. Now, X is the father of C, Y is the mother of C, Z is the brother of C. They also want to join this organization. Now the organization, they have formed a private limited company. The name of the company is B Enterprises. B Enterprises Private Limited. P Limited means Private Limited. B Enterprises Private Limited. B is a shareholder. C is another shareholder. X is another shareholder. Y is another shareholder. Z is another shareholder. There are 5 shareholders in the company. They are the owners of this company. They are owners of this company. The company and the owners, the shareholders, the members are different. There is something called separate legal entity concept in the case of a company. Separate legal entity concept is in the case of a company. So legally also they are different. In accounting also they are different. They are treated differently. But here legally they are one and same. But in accounting they are different. So that is the assumption called business entity concept. So business entity concept or separate entity concept, that is not same as separate legal entity concept. So separate legal entity concept is applicable only in the case of companies, but separate entity concept of accountants is applicable in all these organizations or any organization, whether it is a non-profit organization, a charitable trust or a religious trust, even then the separate entity concept is applicable. The business entity is treated as a different entity so that we can record the transactions of the business with the owner also in the books of accounts of the business. What is the purpose of this? Why we are doing all these things? Why these accountants are doing all these things? To know the profit, to compute the profit correctly, you have to calculate the expenses of the business, the revenue of the business. Profit is revenue minus expenses. If you include the personal revenue of B, the personal expense of B with the business expense of B positive enterprises and business revenue of B positive enterprises, what is the profit you are going to get? So to compute the profit correctly, to calculate the position of assets and liabilities of the business entity correctly, you have to follow this assumption. So this is a basic accounting assumption which is necessary to do the accounting work. Accounting is an art, it's a skill, it can be developed through practice.